Good morning, everyone. We are here, the Holy Macro Show. Kashop is with us today. If you guys didn't get a chance to check out the Gold Rush yesterday, it was just me. The question keeps coming up: what am I doing with gold? Why am I still short bonds? With the Fed cutting rates, what's going on with energy? Why copper miners? I keep getting all these questions. So basically, I just had a rant, answered all those questions, and we'll see where it goes. But I think it was a good video. People seem to enjoy it, so definitely check that one out. Excited to talk with Kashop today. We haven't gotten a chat lately. So much going on in the markets, but Kashop's been out of town, been traveling a little bit. Now we got him today. We want to get his opinion on what's going on with the Fed. We saw the Fed cut rates. They're pricing in two more cuts. Kashop. I know you might not be a little bit out of the loop the last couple days. So they're pricing in two more cuts, one in October now and December. Before it was just another cut in December. So now we're seeing that kind of come into play. I really want to note something though. One is this chart doesn't at the end of the week is usually when we get the Fed data coming into stock charts. So this is another little leg down. But the second they cut rates, the 30-year bounced. They couldn't catch a bid in those bonds in TLT with the Fed cutting rates. And that's something like Kashop and I have been talking about. Hey, you want to watch out for this. Hey, this could happen. If this does happen, this is what we want to do. So we've continued to kind of look at this over the last year, especially, they started cutting rates last year, and the 30-year just went up ever since, as you can see on the chart. Now we're getting closer to the end. Sorry, this isn't my annotated chart. I just was trying to find the daily data. It didn't have it. I just realized that I didn't grab the annotated chart. But we're still seeing this bounce in 30-year yields. Like, it's not doing what everybody thinks it was going to do. Shop, did you get a chance to see the Fed meeting, and what are your opinions on it?
I caught Powell live, and I think considering the pressure that he is in, and especially with Stephen Meran on the board, I think he is dealing with it quite well. And that's not something I ever thought I would hear myself say about someone at the Fed. But it looks, yeah, it looks uh, like the enemy's enemy becomes your friend kind of situation where Powell wants to kind of sort of do the right thing after doing the wrong thing for so long, and the rest of the committee doesn't uh, want to get along with his ideas. And it was very interesting when he said there is no risk-free option anymore, and that is so true. So you are either going to get stagflation or one or the other of it, meaning you're either going to have uh, maybe the Fed doesn't cut and then it's too late, and then you sort of get a deflationary crash, and then they start printing again, and then it's stagflation, or they keep cutting rates into this red hot economy based on some data that, whenever the data comes out the wrong way, Trump says, let's fire the guy who wrote the data. And whenever the data comes out the right way, they say, hey, let's cut rates. So, whatever the unemployment number is, I'm not sure I would even believe those statistics anymore, and even the inflation number. But the inflation number, the beauty of it is you don't have to believe the Fed. You just have to go to the supermarket, go grocery shopping, just do any of the things you normally do, and you can see prices are rising. So, like, I think it's going to be stagflationary. And if they delay the cuts a bit, then maybe we get a little bit of deflation. And a little bit of deflation at this point would be a really, really good thing, because you need that deflation. Like, the robber baron that century, it was nothing but deflation during the even during the time when the Spaniards, they conquered South America and they found all that silver and they were on the silver standard. Yes, there was inflation, but that inflation was like barely anything. I think prices doubled in something like 50 years, and that was it. It wasn't a major catastrophe of inflation. Here you have, let's say, 5% inflation every year, then you're going to see uh, much more significant impacts. And it's not even like it's not evenly spread out. So the inflation here, it hurts the wage earners, it hurts the young. And now, if the unemployment rate is to be believed, then it is hurting job seekers. Whereas the inflation that the Fed is causing, it's benefiting all the asset owners. So you have Larry Ellison becoming the world's richest person for a day. And that happens because Fed money printing fuels rampant speculation, which fuels 40-50% moves in a mega cap stock in a single day, which is totally wild. Like these kind of moves should not be happening, but they are, because right now stocks, no one looks at them in relation to earnings or what they actually represent. Everyone is just looking at it in terms of let's gamble, let's speculate. And why do they do that? That's because the Fed has absolutely destroyed the whole concept of money. They just been, I mean, Powell came out and said it on 60 Minutes. He said, we print money, we print it digitally, and we also print paper currency. And once you hear that, you can't unhear it. Like now everyone knows that all the Fed does is print money, and now they're cutting rates, and everyone's watching, and they're like, "Yeah, you're cutting rates. It's for the rich. Doesn't change my mortgage rates that much. Doesn't change my buy now pay later loan payday rates. None of those change. My credit card interest rate doesn't change. What changes? It changes the rate at which Blackstone and BlackRock and all these private equity guys can borrow. So what this does is it just fuels asset inflation, and that's why you see, so, we were talking right before we got onto the call, and I was like, I'm a little hazy about what's happening. And I'm like, but I see everything is at all time highs. So, that tells you everything. And that kind of does tell you everything. So, either the Fed delays those cuts a bit, and then we get a scenario like a mild deflationary crash before they start printing again, because let's face it, they will start printing again. Or we just skip that mild deflationary crash and go zoom into stagflation right away. So those are the only options. All roads lead to stagflation, which is why the only thing you really need right now is gold and silver. Just stack your gold and silver, and you can do nothing else and you'll be fine. But of course, we are traders, so we're not going to do that. We're going to do a lot of other things. And let me get your thoughts on what else you're looking at in the commodity space.
Yeah, it's interesting. No, you're right, because to me it's the fact that any way we look at this, gold and silver are most likely the winners. And let me explain that a little bit more. I know you get it, but let me explain it to other people. So if we're looking at, we look at the interest rates right now. Let's say the 30-year keeps going up, the Fed keeps lowering rates. That's going to be great for gold. The yield curve getting steeper, and a bull steepening is usually a good environment for gold. Let's say we go into more of a disinflationary environment. Let's say bond yields in the long end really fall. They follow the Fed rate. Most of the time, that leads to people starting to get worried about currency debasement and more. And gold would do well in that type of environment as well. The rest of the commodities would not. Silver would probably have a little bit of harder of a time, but probably be fine. But that would put us in more of a disinflationary regime. And that's also good for gold. So you could basically stack gold, silver, and just kind of walk away. But looking as traders, like what else is out there that we could pay attention to? For me, I keep looking at, and I'm gonna skip a couple charts because there's some significant things here. So I keep looking at this international trade more than anything, and what that means for the environment we're in. Because for me, it's not just, hey, small caps are rising. This is good. We're seeing relative strength. Like, this is telling me that the move in the dollar lower, the move in yields possibly higher, hanging. I mean, really, globally, the yields have been moving higher. If we look at the United States, yes, it's in a range, but the rest of the world's already kind of breaking out to the upside. So I see that. I see these other currencies, especially in Europe, are leading the way. I see that China is really catching a nice bid for once. I see Latin America is starting to move. And then when we look at the small caps inside of it, so I sent this chart to the morning show this morning. Steve covered it beautifully, just kind of going through, what's going on with small caps compared to large caps in these countries. And you're seeing this massive outperformance in the small caps, even compared to the large caps in those countries. But look at our small cap index up 11%. It's doing well. I'm not, talking about it like that's doing badly, but it's not doing nearly as good as these other things. And so as traders, like it's cool to be like, yeah, I'm in the United States, but it's also a lot cooler to be, hey, I'm outperforming the United States because that's what we're trying to do as traders. We're not here to get SPY returns. If you want to do that, just put your money in the SPY and walk away. It makes your life a lot simpler. But if you really want to have this outperformance, you got to go to these other areas. And right now, globally, we're seeing these moves. I do like small caps. I'm not against small caps in the United States at all right now. I'm long small caps, but I'm longer on the small caps in these other areas. But if I'm looking at this market as a whole and seeing what the Fed's doing, seeing what monetary policy is doing, I'm really seeing like, the regime we're in looks more reflationary. Now, I wrote about this, what was that, Tuesday? No, sorry, Wednesday. So I wrote about this Wednesday, talking about the fact that we're seeing all of the growth in the world end up in emerging markets. And I ended up having a really cool conversation with Kevin Muir when we were out of town. I went to Canada. I hit up Kevin. Kevin ended up coming to the event for a minute. We ended up going and getting some food. Had a really good time. But we just chatted about markets mainly, and we talked about, we're both kind of bond bears. We're both into this global trade. We continue to kind of see that the world, like emerging markets, are moving higher, growth wise, GDP wise. That's a fact. You look at Africa; it has probably the most outperformance of any continent at the moment, which is interesting to see. But the United States is really lagging, and to me, the only reason why it's up is really these other countries are kind of pulling it with it at the moment, and that's kind of what we were talking about a lot. We were kind of getting into the dynamics of that. And so I do think that that's kind of the scenario that we're going to be in going forward, which is the environment's reflationary. These emerging markets continue to see growth at levels that we haven't seen in a long time. We're also seeing the relative strength trends like we want to see, like when we're looking at, the S&P 500, or sorry, let's say GDX, and we compare that to GDXJ. We see GDXJ outperforming. That's usually telling us it's a risk-on environment. It's the same thing with these small caps. Brazil's doing well. I think it's up over 30% or something already, maybe even 40. But this Brazilian small caps, EWZS, is up 55%. So that's really telling us something. We got China up 30% in the small cap space. So the Japan up 30% in the small cap space, Europe up 30% in the small cap space. So these are outperforming their large cap counterparts. So my main thought about all of this is that the environment still looks very reflationary, which is going to be good for commodities if that continues. But I think like Kashop said, like as traders, like we also have to think of the other side of the boat, which is the deflationary shock that could happen. And so like I think the best way to look at all of this is just literally let's go right back to the Fed rate. So if we look at the Fed rate, you start to see that get below, you start to see the 30-year get below the Fed rate here. I would say that's a good sign that we're probably heading into more of a deflationary style environment. We see the 30-year continue on its uptrend, making higher highs, higher lows, and finally breaking out. I would be betting heavily on more inflation. And at the moment, I don't see any reason to change that. Most traders would look at this chart, and if it was anything but bonds, they would say, okay, that's an uptrend. Like I'm just talking about technicians. That's an uptrend. We're seeing even in that consolidation, we're seeing higher highs, higher lows. There's a divergence there. You would talk about all these things, and you'd probably say if it was Nvidia, you'd be betting on more upside. Oh, Nvidia is about to break out; it's going to go to $1 billion a share tomorrow. That's what people would be betting on. But because it's bond yields, nobody wants to think that. So, long story short, I'm still looking at a reflationary style environment.
So,
So, go ahead,
what do
Kishore.
you think the odds are of stagflation or unemployment rising in a reflationary environment, which is how we would put it? How do you think about those odds?
So when I'm looking at the environment we're in, and I'm thinking about, okay, well, let's put the models together and figure out what's going on. Basically, for me, I just want to look at the rate of change of these things. And if we look at the rate of change of unemployment, and this is the hard thing about the unemployment data or any of the Fed data, really, even inflation data, it's lagging. So because it's lagging, we get into these periods where, for example, go back to 2022, 23. If you were in the United States at that time, everybody was complaining that they couldn't find a job. Everybody's complaining that like they're broke, inflation's out of control, all these things. However, people, the numbers that the Fed was getting were good. Inflation's coming down for them. You also have unemployment rate very low. So everything was just fine for the Fed at that time. Now you have the Fed talking about, the unemployment numbers and so on. And most of the people I know, and like once again, like I don't know every single person on earth. But in the United States, most of the people I know now they have jobs, they're doing well, everybody feels pretty good. Yes, inflation is really making things hard still, but jobs part of it, most of the people have jobs now. So when I look at that, I think that the reflationary environment will probably sustain because of that. That doesn't mean I think that the United States is in a really good space and that's where you want to be monetarily. I think you still want to get your money out of the United States. I think the US dollar is saying that loud and clear. Not saying like, hey, run for the hills. There's nothing to invest in the United States. There's plenty to invest in. I'm invested in, small caps. I'm invested in some of the sectors inside of the United States. I'm just saying big tech is probably not where you want to be right now. And the way I'm thinking about it as a trader is that think of 2021. I think that's the environment, and we'll go through what these environments really mean. If we go to 2021, we had this massive rally in small caps, energy, cyclicals. Basically, technology was the laggard. And I can remember at the end of that year, I'm having a meeting with a bunch of fund managers, and we're all sitting there. We're at this place. It's I can't remember the name of it, but it's next to a micro center out here in Columbus. And everybody's like depressed, and they're like, "Oh man, I had really bad performance this year compared to the S&P and blah blah blah." And I was like, "Man, 2021 was a great year. What are we talking about?" And it's because everybody was just so heavily long tech because it was a thing that worked for so long. They had no idea that they could get out of it and make money in another way. They weren't even paying attention to the other sectors really. And so what happens in these type of environments, that starts to happen first. And we see, let's say, a reflationary year, let's say next year is more a reflationary year similar to 2021. And then next thing you know, like that puts a lot of pressure on the economy, the world, managers, and so on, because you have that inflation really eating into profits for most of these companies. And so like as everything's kind of reflating at the same time, like tech didn't do bad that year, it just didn't go up as much as everything else. So you get that environment where everything's kind of reflating. Energy stocks, oil, commodities. So there's all this inflation under the surface. And then at some point, the stocks start to be like, hey, I can't sustain up here anymore. And so the stocks start to fall. And that happened, late 21 into 22. Stocks couldn't maintain or catch a bid anymore. And then next thing you know, you have that stagflationary environment. So every market environment usually ends in a reflationary environment, moving into a stagflationary environment. Even think of '08. That was a period of time where that happened. Think of 1982. Think of the Great Depression. I mean, you could go back and look at a lot of these things. Most of the big market environments that shift, that's usually the shift. 2022 is a great example of that. So I think that that's the real thing that I'm looking for here is that reflationary environment, and everything keeps moving and everybody's excited and everybody thinks it's going to end. It's never going to end. We're all going to make money till the end of time. And then next thing you know, you have that the stocks start to stop going up with the commodities, and then the commodities just continue to take off. Everybody starts to panic into some, and I always call the dollar the panic currency. Possibly they panic into dollars. You see those spikes in the dollar that seem to happen during those periods of time. And then that's kind of the end of the cycle. So that's what I would think is probably going to happen. I think, even looking at the small cap to growth chart, um, or small cap to Nasdaq, I think the small caps will start to lead the way, and the Nasdaq will start to slow down a little bit, similar to what we saw in 21, 22. And then we start to get in that environment where the small caps can't really catch a bid anymore because there's so much pressure from inflation. And that's probably how I'd see this market ending. So once again, this isn't today. Still long a lot of things at the moment. Um, but that's what I would think of if I'm trying to think of how this moves from a inflationary environment to a stagflationary environment. And that can happen sooner than I think. That could be something that by year end we're talking about stagflation happening. Or, my opinion right now is next year I think that's going to be more of that stagflationary year.
So I completely agree with your framework and the way you see things going because I think we are on similar lines here. So the part where I'm puzzled is the price of oil. So oil is kind of acting as though the economy is already in a sort of a deflationary, I wouldn't say a crash, but a little bit of deflation, whereas everything else is screaming we are heading to stagflation. So there's a little bit of conflict because oil is the most important commodity to watch when it comes to understanding oil and copper, to understanding what's happening in the economy. And the oil price is like whatever you throw at it, you throw geopolitical shocks, you throw Trump going and gunning people off Venezuela, everything and anything, attacks in Doha, whatever you throw at the oil price or harsher sanctions on India so that they buy uh, oil at the global level and not the Russian oil at a discount. So whatever you throw at the oil price, it's like, hey, I'm not going to move. So is this lack of volatility something? Is there like suppressed volatility hiding beneath the surface, just waiting to burst, and we're going to see a move like we saw with platinum and palladium, where in the blink of an eye they just went up 30% and the move was over. So is oil going to move like that, or are we going to not get into the stagflation environment? What do you think?
That's actually a great thought because that's something that, where I'm still looking at all the time. The thing when you go back, oil tends to just do that. It looks dead. Nobody wants it, and then it jumps. And one thing I think about a lot is why gold, copper, oil, and when you really think about the way the cycle works, well, what I'm talking about here for people that don't know from the chart I share, probably too much, which is gold usually starts the commodity cycle. Copper then starts to move at some point. I usually quantify this by using 52-week highs, and then oil moves last. And so the way I think about it too is let's think about the cycle, big picture. You got gold. Gold's at, let's say, what is it even at today? 37, 38. It just keeps moving. I can't keep up with it. But gold being all the way up there at this point, now we're getting to a point where people want to start opening more gold mines. People are searching for more gold. They need and also they're finding more copper as well. But also they need more energy to get it out of the ground. So this is what I looking back, and this is a thing that I found really interesting, and I wanted to ping off you as well. When you go all the way back and you look at gold and oil and how they kind of move, sometimes they move together. Big commodity cycles, you can see them both kind of making big moves. But most of the time, it's kind of like one's consolidating, one's jumping higher, one's consolidating, one's jumping higher. And that kind of happens again and again. So that's something that I continue to try to look at in this cycle for why. And it's really when everybody's searching for gold, like they're using oil to do it, which is creating this new move in the oil market. And then gold kind of goes sideways as we're seeing everybody kind of digging that gold out of the ground. So once again, it's an interesting thing in the cycle, but that's why oil really moves last. So if we also look at oil just on its own right now, and this is how the cycle works, and when I really go through and try to figure out like how these commodities move, you see like lithium miners and the rare earths start to move right before oil most of the time. And it was something I continue to kind of pay attention to this year and last year. Like, are we going to get this move in the rare earths? Remex is a good one to use for that for ETF traders. So I'm looking at that, trying to get an understanding. Lithium miners, LIT, getting an understanding of that. That starts to move, make a new 52-week high. So I always quantify these moves with 52-week highs. So we see 52-week highs in all of these sectors now, even agribusiness now. Moo is up there as well. Actually, I think I brought. No, I didn't bring the U.S. sector one. Never mind. Just kidding. Um, so I'm seeing all of everything is moving the way it should, right? And that's kind of as a trader, like that's the thing I look for the most is like, is everything moving the way it probably should be moving? Because I can't control anything past that. I can't control, the timing of it. The most of the time people will probably tell me and you, and I've been hearing this a lot, and people keep, tagging me and things. Well, solar is doing so well, and oil is dead, and it's never going to happen. I keep hearing this over and over again, and it reminds me of gold and precious metals, which gold is moving. And you remember everybody was on here hitting us up like, well, the central banks aren't buying gold miners. Well, the central banks aren't buying platinum. And, I would kind of keep the idea that the way the cycles work is when people start to go, hey, gold's pretty expensive here, they're going to start to move to other areas. And we started to see that started to move this year. And so I still think it's the same thing with oil, where we're going to finally get to that point where people are like, hey, what is really going on with oil? And, we're going to see oil make that big move, just like you're talking about, like platinum, because everybody's writing it off. I think like energy is the energy sector, even though it's been one of the most frustrating trades for everybody to trade. It just bounces. It's frustrating. It's annoying. When that thing actually starts to move, I think that's really your signal. You get XLE a weekly close over 100, and that's the signal to really start to get long in the oil space, and then also oil above 80. If we start to see oil break below 50 and we start to see bond yields continue down, that's the opposite side of that trade. Like everybody like macro is in trading generally, not even macro. Screw macro, just talk about trading generally. You always have to understand the two different sides of the equation. Like there's so many people now who just want to be bullish all the time on everything. And like it's great. Like I'm bullish too. The trends are up. But while these trends are up, I always want to think, what is the catalyst that could happen to change these trends? What are the underlying rotations that could happen? This chart really identifies one of them, which is an underlying rotation that we go back into small caps. And we don't have to go like, we did after the dot-com bubble, but having another run like we did in 2020, 21, that would be huge for traders trading small caps. So looking at those rotations, looking at the international rotations, and finally, when we really see those international rotations, when we really see that small cap rotation, I would be extremely surprised to see oil sitting where it's at today. I think oil's probably headed higher, but I think it's just going to take some time.
Yeah, I think you're right. And you just touched on small caps. So the Russell finally made a new all-time high. Uh, this is the first high of this cycle after the 2021 peak. So the problem with the Russell is that all the good companies they grow and then they outgrow the Russell and then they kicked off to one of the other big indices. So the Russell has a way of selling all its winners, which is the opposite of the strategy that you and I employ. But even with that limitation, we are seeing the Russell hitting a all-time high this week. So what do you think is happening? Is this late cycle behavior, or is this a sign that the small caps and not just the previous winners, the actual small caps, the bulk of the economy, that they are catching a bid?
So what's the question exactly?
Do you see it as a sign that the smaller caps are catching a bid now? Or do you see it as a sign that this is kind of a late cycle behavior that, when the when the wind is blowing, the pigs are flying kind of situation.
Yeah, I think the situation that we're in right now with small caps is I think, and like you said with the Russell 2000, let's talk about that a little bit too. Russell 2000, selling I mean, there's a lot of crap in there. There's 2000 stocks. If you're looking at small cap 600, you have to actually have some earnings and whatnot to actually be in there. Russell 2000, anything can be in there, and they kick out the winners quite a bit because when they get too big, they move into the large cap space. The reason why the S&P 500 has done good for so many years is really it's a trend following strategy, momentum strategy, just buying the best of the best more and more as they get bigger. And they can obviously get as big as they want, and there's not an ultimate cap index where they go to once they hit $1 trillion. They stay in the S&P 500, whereas the Russell 2000, they get kicked out and into the S&P 500 when they keep winning. So I do think that that's something to look out for, because I think that, me as a futures trader, at times I'm going to trade the Russell. I think that's an easy way for me to trade it. It's liquid, it's going to move, and I think that's the way I do it well. But if you're an individual trader, not trading futures, finding those individual sectors, those individual stocks inside of those sectors that you want to be in, I think that makes a lot of sense. When you look at, for me, regional banks are very interesting. And this is another area, since we're talking about small caps, since we're talking about oil, regional banks is going to be the one that I really want to look out for right now. I want to look at you could look at the KRE. It's not the best ETF, but looking at the individual stocks in there, seeing what the breadth of that sector is doing. And the reason why is a lot of those regional banks are heavily invested in oil and energy. And on top of it, they make a lot of money from the yield curve steepening. So that also is beneficial to oil, as there's only liquidity in the market, possibly more growth going out there into the world, and so on. So you'll see, if you look at that sector, you can kind of get a good feeling of it, of what's going on in the market. That to me is one of the best indicators of, I mean, Kashop seen me use KRE for years. It's one of the best indicators for crashes, market turns, market bottoms. It's one of my favorite indicators to use. But I think that sector's inside of the small cap sector is really going to be an interesting one to continue to pay attention to. A lot of people keep talking about biotechs. I'm not the biggest fan of biotechs. I have nothing against it. But I think in this environment, that's probably not going to be where the most alpha is made. Also, it's a very hard sector to trade. Like I trade the ETF if I trade that sector. If you really know the inside of the sector, great, do it. But I feel like the only people who really know sectors like that well are people who, either work in the industry or know someone who works in the industry really well. And that's about it. And I mean, I had some friends who would be like, call me sometimes, be like, hey man, we have a secret conversation about biotechs. I'm like, actually, no. And like I said, I don't trade those individual stocks anyways, so it wouldn't matter. But don't call me like that. But that's kind of how I've always heard about that space, and it's kind of been true over the years. Like I heard that it was a bunch of insider trading, and then as the years went on, like I got a bunch of phone calls like that from random people over the years. So it's definitely a sector I want to kind of say might go up, but at the same time, like I don't want to own the individual stocks. I don't know enough about them, and if you do, fantastic. But yeah, so the biggest thing to me about the small cap trade here is everybody keeps talking about the fact that you're going to see this small cap trade die forever, and the fact that the dot-com bubble happened and it came off, and that'll never happen again. And now we're in this regime where the NASDAQ 100 and large caps will lead for the rest of time until we're literally done trading, until we're old men. And that's what I keep hearing, and that's getting me more and more bullish on the small cap trade, and the possible environment change that we're going to see going into the end of this year and the next year. Another thing to think about too is seasonality. Now, I'm not one to trade on seasonality, but I like to pay attention to it because if it works with the seasonal trends and it bucks the seasonal downtrends, then I want to be more bullish on that sector. So small caps, we call it small cap season. Jeffrey Hirsch, Stock Traders Almanac, talks about this a lot. Basically, small caps around October start to bottom out and be the outperformer into year end. And this has happened a lot of years, even recently, even during all this massive uptrend that everybody keeps talking about in large caps. Like that's happened quite a bit. So if we get back into that kind of position where we see small caps really leading the way from October, I mean, they led the way. Like a lot of people just don't even have any clue that small caps off that low, the Liberation Day lows. I mean, the Russell's up 40% now. The IWC is up 50%. That's the microcap sector. The microcap sector. I haven't talked. I don't know the last time I talked about the microcap sector in many years, but that's something that's kind of telling us like, hey, this shift might really be happening. And either way, like Kashop said, this isn't like the small cap 600 or the Russell 2000 isn't the best way to trade these. Finding traders, who find, or if you're a trader who can find these individual sectors, individual stocks inside these sectors, some of these are really ripping in a much bigger way than a 40 and 50%. So I think in the year end, like if I'm really trying to make some sort of a prediction, which that's not my game, but if I'm trying to, because I'm a trader, at the end of the day, it's just the price is doing this, I'm doing this, the trends are long, the regime is saying this. That's what I do. But as a person who's looking at it going forward, and if I was going to take my best guess, gun to my head, I think the shift will continue into small caps, micro caps, energy stocks. Will probably catch a bid by year end, getting up and over that 100. Copper miners, I think that's the place you want to be more than anything else. I think that's the thing that nobody's really saying right now, which is everybody's arguing over gold and energy, and nobody's really talking about the fact that the copper miners actually look much better than if you're looking for a new trend. Like I'm still long all the gold miners. Don't think what I'm going to say is saying like I'm not long the gold miners. Still I am. But I also really like, if you want a new trend that's just starting to move, I think the copper miners are it. Global COPEX is hitting 52-week highs. We're approaching those, I think that's 2011 highs. XME is just raging higher. It looks kind of ridiculous at the moment. And if you look at the international copper names, they look even better than the U.S. copper names. So I definitely like the idea of getting outside the U.S., buying some of these copper miners. And I think that's really the trade into year end that's probably going to take off. And if that continues, energy will join it at some point. It's not going to be a situation where we're sitting here in 2026 and saying, well, copper miners are up 500% and energy is still sitting below 100. Like that would be the most impossible situation I probably have ever seen in the markets. And markets like to make a fool out of the most people. So once again, anything can happen in markets. I just think that would be one that would surprise the hell out of me.
Yeah, and speaking of copper, so there have been some fundamental bullish developments as well. Bullish in terms of the price. So Freeport, the biggest copper miner in the world, so they announced that they had a production suspension at one particular block of their mine in Indonesia. So that happened because of a ore spill. And then you had Ivanhoe Mines in the DRC, and they said that they had a seismic event like a earthquake, which disrupted their operations there. So this comes on top of, like, we have been talking about this for the last couple of years. So you had the big disaster with Cobre Panama in Panama that cut off around 2% of the world's copper supply, and 2% here is a big deal. So that mine has yet to come back on, and then you have these new supply disruptions coming into place. And the Resolution Copper project in the US. So Trump was supposed to fast track it and get it into production, and nothing has happened yet. So they had to do a land swap, and even that hasn't gone through. So it's been very slow. And permitting a new copper mine takes something like a decade. So when you have these even small disruptions in productions, even small drops in supply, the impact is going to be huge. Now, the offsetting factor is that everyone thought Trump was going to impose huge tariffs on copper, and traders just imported a ton of copper into the US, and then Trump said, we are going to exempt copper concentrate, copper ore from tariffs. And then there was the huge differential between the London price and the US price, and now that's kind of normalizing. So if you're just looking at the copper futures in the US, which is your HG, then you're probably going to be like, why are copper miners hitting all-time highs? Look at what's happening with the copper futures price. But if you look at the actual fundamentals behind the move in the copper miners, if you look at the actual production shortfalls and all the issues the miners are facing, if you look at all that, then you can kind of get an understanding of why copper is moving the way it is moving. And I think a lot of people, who are just looking at the charts or the price charts of the metal in the US, they are missing this picture, which is why the copper miners haven't moved as much as they should have moved, which means, there's more upside to this trade. So now I've been in the copper trade for the last couple of years. I had Ivanhoe, and now I have a few stocks which are for my subscribers, but I still think this trade has a lot of room to run. So I haven't taken profits on the copper positions, and I'm just going to let it run until the time comes. And that time is not now.
Yeah, I think that's the hardest thing, and it's something that I talked about yesterday, which is the hardest thing as a trader is to really be able to sit on your hands during these major trends. Like you're seeing, like let's go back, find a major trend. I don't think I brought major trends, but let's look at the international stocks. How do you hang on to these type of trends? So many people would go, be out of it by now. A little bit of volatility, they would say this is over. Not to mention you have your own home country bias, and everybody in the world seems to have a US bias these days. So, you're already kind of iffy because you're like, well, Poland, hasn't done well in a long time. Greece, oh my God, I can't stay long Greece. It's Greece, the financial crisis and all of these things. And your brain just kind of goes crazy. And most people are out of these trends. And it's just like copper, like you're talking about. It's something that I tried. I was having a conversation with my buddy Andy the other day, and I said, the quote, um, all of humanity's problems come from man's inability to sit in a room quietly by themselves. That quote always comes to my mind as a trader, because when we're in these trends and really trying to hang on to these trends, like it's mainly the fact that like we talk ourselves out of these things. Um, at the end of the day, I'm always the guy, this is the reason why I have such crazy opinions once I'm in something. I don't like once I'm in a position, there's nothing that can shake me out of that position anymore. If I put it on and the trend is up and I have the right signals and the regime models and so on, I'm long that position. And there could be news coming out every single day. There could be God coming down to me and telling me to get out of those positions. There could be anything can happen. There could be a lot of volatility. It could be Liberation Day, but it didn't hit my sell signal. Whatever it is, I will be in that position until that sell signal is hit technically. That's the best way to do it, to really hang on to these trends. And it's the same for when you're looking at even if you're fundamental, like understand where that point is where you're going to get out before you get in. And the reason you want to do that is once you're in the trade, and once you, like, let's say you're in GDX and you're up 20% and you're like, man, this is cool. And you're a trader who's, every trader has watched profits evaporate, especially when you're a new trader. That feels terrible. So you're like, oh, I probably should get out of this position. And then you get out of the position and then it goes up, 100%. That's why you want to just understand like where you're getting out before you get in. If you're not able to do that, you're going to make so many mistakes as a trader. And like this is something that's like way more important than anything else we're saying today, which is once you're in a trade and you're making money or losing money, your bias is going to come in like every single time. If it's going down, you're going to think it's the end of the world. If you're a new trader, you're probably going to think maybe I should buy more, double the position. If you're in an uptrend and you're making money, you want to get out, you want to get your profits and run. So this is the way you really want to hang on to these things, whether it's copper miners, global stocks, gold miners, whatever it is. You want to hang on to these things because you want to know exactly where you're getting out before you get in. And that doesn't, there's nothing about it has to be a technical signal. There's nothing about it has to be a fundamental signal. It's just about you have to figure that out beforehand. And, every single good trader would tell you that. So, all right, guys, I
Yeah.
think we got to run. Kashop, if you got anything to end on, I ran over time a little bit.
No, I think you nailed it. I think you nailed it perfectly.
Awesome. Well, guys, we'll see you guys next week. And we'll see you guys soon. Thanks for joining us. Check out Kashop's page on Twitter. I tagged him on there. It's Kashop286, right?
Yeah.
Okay, at Kashop286. And I'm Jason. I will see you guys next week.
Thanks, everyone.